Important attributes of capital budgeting in the capital budgeting problem. We need to talk about three criteria that's ideal for these evaluation methods. And the first one is that we need to be able to consider all cash flows that are going to be relevant to this project. This will be important in order to determine whether or not the project's going to be profitable. The second ideal criteria for an evaluation method is that we need to consider the timing of the cash flows. You've learned in the time value of money chapter that $1 today is worth more than $1 tomorrow. And therefore, we need to be aware of when we're going to receive these cash flows, and that will affect the overall profitability of the project. And the third criteria is we need to be aware of all of the risks that are associated with a particular project. The cost of capital is going to be important in accounting for some of those risks, but we should be aware of them as we go forward. Now let's talk about some of these evaluation methods. Time value of money and capital investment. The concept of time value of money can also help us in terms of capital projects. It can help us decide which capital project will add the most value and what the actual worth is of that project to our company today. When we make financial projections for a capital investment project, we then want to discount or bring back those financial values to what they would be worth today at an appropriate discount rate. By doing this, we are able to look at all projects in a common size to see what their worth is today, and if it is worth the investment of what it would cost today to actually do the project. So in summary, when you are looking at doing a capital investment project, first forecast those investment opportunities and financial projections for the project, and then discount them back at an appropriate discount rate, determine what the value or worth of that project is today in today's dollars. Cost of capital and capital investment. The cost of capital is associated with capital budgeting in this respect. So suppose a firm has an opportunity to invest, say $50 million in a marketing campaign. And this marketing campaign might provide cash flows of, say, $17 million over each of the next 3 years. We know that the value of any asset is equal to the present value of its future cash flows. And so the value of this project is just going to be equal to the present value of the cash flows that come to this marketing campaign. The rate at which we discount back these future cash flows is going to be the cost of capital. So hopefully by now you understand that the cost of capital is going to be important for the capital budgeting problem. Cash flow estimation in capital investment. Here we're going to talk about which cash flows that you should count in the capital budgeting problem. We should count all relevant cash flows, all incremental cash flows that come from a project. Think about this capital budgeting problem from a CEO's perspective. We want to see if it's going to increase the overall value of the firm, not necessarily just one division within the firm. And so we want to account for every type of cash flow that's going to be influenced by this project. There might also be incidental cash flows that we'll talk about as well. These incidental cash flows might be positive or negative. Think for a second about a car company that creates a small-size sedan that might compete with its own sedans out there, right? This cannibalization cost or this erosion cost that has occurred. The sale of one sedan might erode away from sales of another sedan. We'll talk about this here shortly. We'll talk about sunk costs and opportunity cost, whether we should account for sunk costs and whether or not we should account for opportunity costs. Think of a company that has invested a lot of money in the past in buying a big parcel of land, and now they're thinking about whether or not to build some manufacturing building on this land. Should they account for the cost of the land that occurred many years ago? We'll talk about that here shortly. And lastly, opportunity costs. I think it's important to understand opportunity costs. Your opportunity cost of reading this textbook and taking this course is probably pretty large. You could be doing other things right now. Similarly, companies can be doing other things with their capital. And so we'll need to account for opportunity cost in the capital budgeting problem. Important attributes of capital budgeting. An ideal evaluation method for capital investment considers three things: all the cash flows in the project, the timing of cash flows, and the cost of capital or risk of the project. In most cases, you should use NPV as the primary method and use the other methods to supplement when making capital investment decisions. If there are capital constraints when choosing multiple projects, use the PI to rank the projects and then decide which projects to do based on the PI ranking. Time value of money and capital investment. Time value of money can help firms and individuals compare the relative value of projects of varying scope, size, and duration. including different capital investment opportunities. If the present value of the benefits of a capital investment exceeds the present value of the cost of the investment, then it will add value to the firm and shareholders. Cost of capital and capital investment. The investors in a firm have different required rates of return based on what type of security they invest in: bonds, preferred stocks, or common stocks. The required rate of return for the investors is the cost of capital to the firm, or the cost of raising cash for capital investment. Even if projects are seemingly the same, each project has different inherent risks that change the cost of capital to the firm. Capital raised by debt, such as mortgages and bonds, have tax shields, but they do not produce an optimal capital structure for the firm. Cash flow estimation in capital investment. Incremental cash flows should be included when estimating cash flows of a project. Incidental cash flows are a type of incremental cash flow that are indirectly created by a project but are not explicit revenues or costs. Opportunity cost should also be accounted for in capital budgeting for a capital investment, because a company loses its ability to use the same assets somewhere else. Sunk costs are the costs that have already been incurred and are irrelevant to the project evaluation. Summary for the capital budgeting process of capital investment. It is essential to consider the time value of money, the risk of a project, and all the cash flows of a project to evaluate whether the project is worthwhile. The NPV should be used as the primary tool to evaluate projects in conjunction with other capital budgeting criteria that give supplemental information. The PI is useful to evaluate competing non-mutually exclusive projects with budget constraints. The time value of money accounts for the opportunity cost of capital investment by making sure that the values of cash flows received at different times are comparable. The cost of capital accounts for the risk of a project, because investors demand a certain required rate of return on their investment, given the level of risk they have to take. It is essential to include incremental cash flows and opportunity costs, but not sunk costs, to correctly derive the capital budgeting criteria and make a decision. Why is it important to consider all relevant cash flows in an ideal evaluation method for capital investment? Without considering every cash flow of a potential project, you do not know how the project will enhance the value of a firm. You need to include all the cash flows coming from a potential project to understand how much value they will add to the firm. Telia is comparing 4 mutually exclusive projects. In order to choose the best project to optimize the goal of the firm, which capital budgeting method should Telia use? Net present value, NPV. When you compare mutually exclusive projects, you should look at how much value is added by each project, because you can do only one of them. Therefore, you should use the NPV method to choose a project. Alphabet Co. has $50,000 to spend on capital investment projects for the next year. It will do as many projects as it has cash for. Alphabet Co. calculates the potential incremental cash flows and costs of the projects as well as the NPV, IRR, and PI for each project. How should the company decide which projects to invest, and if it wants to maximize the total amount of value created? It should choose the projects with the highest PIs until all capital has been used. By choosing the projects with the highest PI, Alphabet Co. will be able to use its limited capital effectively to create the most overall value for the firm. What is opportunity cost as it relates to the time value of money? It is the opportunity you forego to invest in other options due to the time scope of an investment. Opportunity cost is the cost that you have to give up for something as a result of investing in something else. Why is the timing of cash flows an important characteristic of capital investment? Timing of cash flows is related to the opportunity costs associated with those cash flows. The cash flows of an investment need to be compared to the cash flows of other projects. You are considering 4 projects. The initial cost to start each project is $500,000, and the total cash inflows generated by each project are $600,000. Each project also has the same level of risk. The only difference between these 4 projects is the cash flow patterns. Given the information above, which statement is correct about these 4 projects? Project D should be chosen first given that the project will receive cash to sum to $600,000 the most quickly. Project D receives cash flows the most quickly of the 4 projects. Given the concept of the time value of money, Project D should generate the highest NPV. Why is there always a cost for bringing funds into a business? A business must compensate investors for the risk that they are taking to invest in the business. Investors need a reason to part with their money. What is the relationship between the risk and the rate of return? The higher the risk investors have to take on, the higher return they require. Investors will take on more risk if there is potential for a higher return. How can having more debt benefit a company? How a company will fund its assets and operations, namely, what proportions of debt and equity the business will use. This correctly characterizes a finance decision. What are incremental cash flows? Any additional cash flows, whether in or out of the firm, that are created as a result of accepting a project. This is the correct definition of incremental cash flows. How does allocated overhead affect the selection of capital investment projects? These cash flows are not a direct result of a specific project, but are a general cost to the firm. These cash flows are irrelevant to your analysis. How are non-incremental cash flows different from incidental cash flows? Incidental cash flows are indirect cash flows that are not explicitly revenues or costs. Nevertheless, they must be included in the analysis. Incidental cash flows are included in analysis and non-incremental cash flows are not. How does cannibalization factor into capital investment decisions? If your company is planning on launching a product, and that product is going to steal some of the sales of another of the company's products, that loss of sales could be an incidental cost or revenue caused by the new product. This is the correct definition of cannibalization. A company is considering 5 projects that are not mutually exclusive. However, the company does not have enough money to do all of them. In order to prioritize projects that fit within the company's budget, which capital budgeting method should be used? Profitability Index (PI). The PI should be used first to compare the projects, and then to rank them to maximize the value of the firm. Which scenario is an example of an opportunity cost that is not associated with cash flows? Albert decides to stay home and study for his test instead of going to the movies. The opportunity cost is going to the movies. Which condition indicates that an investment will add value to a company? The present value of the benefits of the investment outweigh the present value of the costs of the investment. If the project provides more value than it costs, that mathematically it will add value to the company. How do corporations and purchasers of financial securities view returns? Purchasers of financial securities look at returns as the amount of money they require in order to lend or give their money to the corporation that issued those securities. This is a correct description of returns from the viewpoint of investors. Corporations look at high returns as a cost to investors that prevents them from either lending to or investing in a corporation. What is an opportunity cost? The loss of the ability to use an asset toward the next best project. Once you have invested it in another project, the concept of opportunity cost is that because you use an asset to invest in one project, you lose the opportunity to use the same asset to do a different project.